Hey everyone, so if you've been looking into getting a HELOC with bad credit, here's the super short version. Most lenders will not approve you. Once your credit score drops into the 500s or even low 6s, it's almost always a no. Even if you got a good amount of equity in the house, that doesn't matter basically at all if your debt or credit score is outside their range. So let's say your home is worth $400,000, okay? You paid down a decent chunk of it, the market's gone up, you got real equity built. But if your FICO is too low, the bank isn't looking at the house, they're looking at your credit and your monthly obligations. And when either one is too high, you're out. And here's where that gets frustrating because high-end debt pulls your credit score down, raises your DTI, and then those are the exact things that HELOC lenders screen for. So the more you actually need help, the harder it is to get to qualify for it. It's messed up. You got the equity, but you can't unlock it, at least not in the usual way. So in this video, I'm going to explain exactly why HELOCs are so hard to qualify for when credit is a concern, what traditional loans unfortunately don't fix, and how something called a home equity investment works a bit differently, especially if you're looking for a way to access equity without another monthly payment. Now, just to be clear, traditional lending isn't completely off limits if your credit's not perfect. Some lenders will consider a HELOC or even a cash out refi with a score in the low 600s, but what usually happens is the terms get real bad. You might still get approved, sure, but with a much, much higher interest rate, adding closing costs and possibly a lower loan amount, and of course, you're taking on a new monthly payment. So if you're already carrying high interest debt, you're now layering on another obligation, which pushes your debt to income ratio even higher. Right? See, that's the trap. You're trying to use your equity to get back on track, but the loan itself makes your monthly finances even tighter. Cash out refinancing can feel like a workaround, but it comes with the same issue. You got to replace your entire mortgage. And if your original rate was locked in years ago, nowadays, you're probably going to end up with a much higher one. That can raise your total housing costs, even if you get some short-term cash out of it. So in a lot of cases, these tools don't just make it harder to qualify, they can actually leave you in a worse position than where you started. Now, by this point, it's pretty clear traditional lenders they're not set up for people dealing with real financial pressure. They're focused on credit scores, income, debt ratios, and if those are out of range, the answer is usually a flat no. So what do you do if the equity is there, but the loan options aren't? Well, this is where a home equity investment comes in. And the big difference here is they're not loans at all. You're not borrowing money and paying it back with interest. You're getting a lump sum now in exchange for a small share of your home's future value later on. It almost never requires an income check or minimum credit score to qualify. And since there's nothing added to your monthly budget, it doesn't raise your DTI either, which is why it works for people who are locked out of traditional options. Nothing is owed until you sell, refinance, or decide to buy them out. So you're not stuck juggling a new payment every month. You get breathing room now, deal with the rest later. It's equity access without the weight of another loan. So let's go back to that $400,000 home example from earlier. Let's say you qualify and you get $50,000 through a home equity investment from Point. You can use it to wipe out a big chunk of your credit card balances, which brings down your interest payments, and that hits your credit score in the best way. Around 75% of people who use a structure like Points see their FICO scores go up. On average, it climbs by 53 points. And for about a third of users, it jumps by more than 75 points within just 3 years. Mostly because you finally cleared off the revolving debt that has been dragging it down the whole time. Now, the trade-off is simple, and Point is very upfront about it. When you sell the home, refi, or buy out the agreement, Point will get a share of what the home is worth at that time. But if the market dips and your home is worth less than expected, then they take that hit with you. What you owe will drop as well. You're not locked into some fixed repayment. There's no extra charge if prices fall. So you get the cash now and the flexibility to deal with the rest later on your own terms. Now, the big question is, would you even qualify for something like this? And the great news is it's way more accessible than a traditional HELOC. Point doesn't have an income requirement at all. There's no DTI calculation. You don't need a near perfect credit score just to be considered. In fact, the minimum FICO is literally 500. So if your credit's been through some rough patches, but you still got real equity in a home, there's a good chance you're in range. And even better, checking doesn't impact your credit. There's no hard pull here. No penalty for just seeing what the numbers might look like. You can find out if it's a fit without locking yourself into anything. So if you got equity, but everything else, credit, income, debt, it all keeps disqualifying you from loans, Point is one of the few ways to actually access that equity without taking on more monthly pressure. So here's the clean way to think about it. If you're sitting there with credit card balances that just keep growing, or bills that never really feel caught up, then sharing some future upside to fix that now can be a very reasonable trade. You're basically saying, I'll give up a little later to stop bleeding today. But if you don't actually need the money right now and your home's in an area where prices have been climbing fast, then it's worth slowing down and running the numbers. In that case, holding on to every bit of future value might matter more than pulling cash out early. The other thing people underestimate is flexibility. With Point, this is not locked into some rigid schedule. If your situation improves in a few years, you can refinance or buy it out. If life changes and you sell, it ends there. You're not boxed into a single outcome. So this really comes down to one question. Is getting your finances under control now worth giving up a portion of future appreciation later? And for a lot of people, that answer is a resounding yes. So can you get a HELOC with bad credit? Well, for most people under 680, it's going to be really tough. And that's exactly why Point exists. It gives you that way to access the cash in your home, even when traditional lenders say no. If that does sound like it could help you out, I left an affiliate link down in the description and in the comments where you can check for pre-qualification. It doesn't affect your credit or cost you anything extra at all, but we might get a small commission on it. It really does help out the channel. And we usually have some special offers or exclusive deals there that you won't see if you go through their main site. So feel free to check that one out if you're interested. Also, if you'd like to work with us or sponsor a future video, just reach out using the email in the description below. Okay, I really hope this helped clarify things, and if it did, I'd appreciate a thumbs up on the video. If you got any questions at all, drop a comment down below. This stuff's complicated. I read all of them, and I'll try to respond to as many as I can. Guys, thank you so much for watching, and I will see you in the next one.